to this week's Money Metals podcast, helping gold and silver investors during these turbulent times. Now, this week's market wrap with commentary and analysis from Money Metals Exchange, the company named Best Overall Precious Metals Dealer by Investopedia.
Welcome to this week's Market Wrap podcast. I'm Mike Gleason. Coming up, don't miss our exclusive interview with Jordan Roy-Byrne, a chartered market technician and master of financial technical analysis, editor and publisher of The Daily Gold, and he's also the author of a brand new book titled Gold and Silver: The Greatest Bull Market Has Begun. Jordan lays out the case for gold having broken out of a 13-year-long trading range, signaling the start of a new long-term uptrend. And he also explains why he thinks now is the time that silver will finally outperform gold after years of frustration for silver bugs on that front. So stick around for a fascinating interview with Jordan Roy-Byrne, market technician, author, and metals analyst, coming up after this week's market update. Strong demand for gold coupled with the movement of metal to New York has caused a dramatic gold bar production problem at the state-owned Korea Minting and Security Printing Corporation. Comasco mints gold coins and bars along with other security items, including banknotes, IDs, and passports. Among its many products, the government enterprise supplies bullion bars to Korean commercial banks, retail outlets, and online malls. Due to the shortage of raw gold available at nearby refineries, the mint was forced to suspend the sale of gold bars last month, and the suspension is ongoing. The problem appears to be a combination of strong retail demand for physical gold in South Korea and disruption in the gold market due to gold moving west, coupled with poor planning at the mint. Earlier this year, the prices of gold and silver futures traded on the COMEX surged above the spot price of gold in London and other markets. Mainstream analysts blame the dynamic on the threat of tariffs pushing the futures price of gold and silver higher in New York. But as Chris Powell of the Gold Antitrust Action Committee reported, there could be a more fundamental issue at play: the fact that there is a lot more paper gold than physical metal. Regardless of the reason, the movement of gold has driven record outflows of gold from London vaults, and it pressured availability in Asia as well. According to a Reuters article last month, quote, gold bullion banks are flying gold into the United States from trading hubs catering to Asian consumers, including Dubai and Hong Kong, to capitalize on the unusually high premium that U.S. gold futures are enjoying over spot prices, end quote. At the same time, there has been a surge of retail demand for gold products in South Korea. Last year, Korea's largest convenience store chain, CU, teamed up with Korea Minting and Security Printing Corporation to offer customers fingernail-sized gold bars. The bars come in a range of sizes between 0.1 grams and 1.87 grams. The largest bars sell for 225,000 won, the equivalent of about $165. The gold is packaged in cards that feature various graphics and messages. Similar products are sold in vending machines. According to a CNBC report, machines in Seoul have sold out of these small bars. A State Street Global Advisors analyst told CNBC this reflects the surging demand for gold, pointing out that the sudden spike in gold demand in South Korea led to the Korean banks to temporarily suspend gold bar sales at the request of Comasco, as there are not enough gold bars in the country to fulfill local demand. Analysts say several factors, including domestic political turmoil, along with geopolitical and economic uncertainty sparked by the threat of a trade war, are driving safe haven demand. It also appears that Comasco made some poor decisions, exacerbating its current shortage. As noted, there was a surge of gold moving to New York over the past 3 months. Traders made deliveries to the COMEX in kilogram bars, the preferred form of commercial gold in Asia and the Middle East. World Gold Council analyst John Reed speculated that as they sought to take advantage of the arbitrage opportunities in New York, traders scrounge around the globe to obtain bars, noting that Korean refiners and wholesalers probably got a phone call and said, "We will buy your entire stock off you at a good premium, stick it on a plane and send it to New York." Refineries probably jumped on the offer to make a quick buck, and mints like Comasco were left flat-footed. The premium that could be captured by delivering large gold bars to the COMEX rose to over $50 an ounce at one point. So those in the business of minting and selling little wafer bars are going to get a much higher premium on those items, making it critical for a mint to have plenty of gold feedstock, even if it costs more than usual. Poor planning by mints and also dealers can certainly sour relationships with customers. The problems apparent at the Korea-owned mint are similar to problems seen at other government mints from time to time. We've constantly written about the sad 2020 to 2023 saga of American Silver Eagle shortages and sky-high premiums caused by embarrassing mismanagement by government bureaucrats at America's own U.S. Mint. Privately owned mints have historically been much more reliable suppliers and provide more reasonable and stable pricing. This is a key reason why Money Metals constantly encourages customers to focus on rounds and bars rather than government-minted coins. After all, silver is silver and gold is gold. As for this week's market action, gold is back in the green after pulling back last week, which ended an 8-week winning streak. The yellow metal currently checks in at $2,922 an ounce, up 1.8% for the week. Turning to silver, which is having a nice week of its own here. The white metal is up just over $1 or 3.3% since last Friday's close to check in at $32.40 an ounce. We'll hear some real good discussion on silver coming up here in this week's interview, so stick around for that. Our guest is quite bullish on where things are headed and has some very bold forecasts for the metal. Finally, on the PGMs, platinum is up 1.7% to trade at $976, and palladium is up 2% and trades just a tick higher than its cousin platinum. The industrial metal checks in at $977 with just a few hours left here in trading for the week. Well, now, without further delay, let's get right to our exclusive interview.
Greetings, I'm Mike Maharrey, an analyst and reporter here at Money Metals, and I'm joined today by Jordan Roy-Byrne. Jordan is a chartered market technician and master of financial technical analysis. He's the editor and publisher of the Daily Gold and the Daily Gold Premium, and he's also the author of a brand new book that I believe just came out in January, titled Gold and Silver, The Greatest Bull Market Has Begun. Greetings, Jordan. How are you?
Hey, Mike. I'm great. Thanks for having me.
Well, I really appreciate you taking a little bit of time to hang out with me here on the show, and looking forward to digging into some gold and silver market stuff here. So I'm right. You did just release the book in January. Am I correct about that?
Yes, I released it for free, although it is going up on Amazon. Should be very shortly. Should be any day now. It will be a hardcover version, and
Nice.
and I was against a paperback because, as you know, there's quite a few charts and images in the book, so
Right.
I don't want those to fade over time.
Yeah, absolutely. Well, your timing couldn't have been better. Obviously, both the gold and silver markets have been kind of in a bull run for the last, well over a year now. And so I would like for you just to make the elevator case for why you think this bull market is going to continue.
Well, that's difficult because I could probably give you like a 200-page thesis or a 10-page thesis.
That's why I said elevator.
Well, the elevator pitch is you have the major asset classes, gold, or I should say stocks, commodities, bonds, and of course, gold is the granddaddy of commodities, and they move in secular trends. Stocks tend to move for 15 to 20 years. Bonds tend to move even longer than that. They can have 30 to 40-year secular trends. And for gold, historically, it's not always uniform, but the last two secular bull markets were about 10 or 11 years or so. So asset markets have these secular trends, and bonds have already, the bonds are now in a secular bear market, which we've only seen one of those in the last 100 years, which was 1965 to 1982. And stocks are really close to the end of a secular bull. Mm-hmm. And so this is really mirroring what happened in the mid to late 1960s and 1970s. And so we know that gold, having broken out of that 13-year cup and handle pattern and going above $2,100 an ounce, now it's in a new secular bull market. And when the stock market secular bull ends, which, I mean, who knows, it could be 2 or 3 years or 2 or 3 months. When that ends, you are going to see, or you have the setup for gold and silver and all commodities going dramatically higher, because you, like the late 60s and 70s, this will be a time when the two major asset classes are in secular bears, and hard assets will be in a secular bull. So that's kind of the 50,000 foot view and elevator pitch. And so gold and silver, gold especially, they've already performed well, but they will perform even better when we get this break in the secular uptrend in stocks.
Yeah, that makes sense to me. And, that kind of brings me to maybe a peripheral question, but it's something that I'm curious about. You, as you kind of alluded to, you use a lot, or that might have been when we were talking before we were on air, but you use a lot of charts and you do a lot of technical analysis. And I'll be honest, that's not something that is really in my wheelhouse. Can you kind of explain to the listener kind of what is technical analysis and why is it valuable? Because I think a lot of people just kind of invest on their gut, to be honest with you.
Well, it's the study of trends and market action. And like sometimes it gets a bad rap because now with the proliferation of technology and social media, you can see lots of bad and faulty technical analysis. And, at times I probably did that earlier in my career, 7, 10, 12 years ago. I probably contributed to that bad technical analysis, but it's really the study of price trends. And you're really at the core of it, you're really assessing supply and demand. So technical analysis, it can be predictive when you're looking at price charts, but it's really the study of supply and demand. And what I like doing, or the area of technical analysis, which is new as far as 20 or 25 years, which I really like most, is intermarket analysis. And that's studying the various moves in all these different markets and how they kind of align or impact each other. And at the same time, I really enjoy looking at in the same segment. I enjoy, comparing like gold against the stock market, gold against bonds. How's gold doing against this? What's the gold silver ratio doing? So if you know how to use technical analysis, you can glean significant information from that. And, even though I'm a technical analysis is my trade, I'm trying to put it forth in this book in a way that people can understand. Even though it can seem really technical, I'm trying to convey some basic viewpoints, like kind of what we talked about at the start. I mean, in addition to looking at fundamentals, and there's also, in terms of sentiment and money flows, like people in technical analysis study that. I don't know if studying sentiment if that's directly a branch of technical analysis or not. I mean, I guess it is. It's not really charting, but you're looking at all these different things where you're assessing data and you're assessing facts versus. And I do think fundamental analysis is great. Like I'm not only looking at one thing in my work, because you have to look at everything. But right. sometimes with fundamental analysis, what's the economy doing, or what's is GDP going to be minus 1% or 2 or 3%? What's going to happen with this company? And so that can be a lot more difficult to predict. Whereas if you're looking at technical analysis, there's a number of things that you can look at that actually help convey fundamental information. Like, it sounds ridiculous, but you can look at, okay, what happens before a recession or what happens before stagflation. I mean, you can look at various charts of various markets and assess, okay, is this lining up with what I'm seeing in the economy? Is there something different here in the charts? Could this be conveying a trend change? So that's how I look at technical analysis. I don't look at it as entirely predictive. I look at it as something that together with fundamental analysis can be really, really powerful. And so the way I'm looking at it in this book is really a 50,000 foot view. So people understand, look, the bond market is clearly broken. We've only seen one secular bear bond market in the last 100 years. And so it's insights like that in the book that I think can give people a real, even though it's kind of basic, like it can give you a really strong understanding of, or a guide of what's happening right now and what this can lead to.
Yeah, that really makes sense to me. It's interesting because when you mentioned the secular bear market in bonds, I've only heard one other person really out there talking about that, and that's Jim Grant. And he makes the same case, that the bond cycle is very, very long. and we're just now coming out of this very, very long bull market in bonds, and he's talking about the same kinds of things, but you don't hear that kind of analysis a whole lot, except from folks that are kind of, I think a lot of people would consider a little outside of the mainstream, as the saying goes. So that makes total sense to me.
Sorry, go ahead.
No, you go ahead. I was going to move on to something else, so I finished the thought.
Oh, yeah. I mean, well, and the thing about bonds is this is such a massive asset class. I mean, this is really the biggest asset class. And so when you think about it, we've only had, other than 1965 to 1982, bonds have been trending higher, or at least sideways to higher, or really higher for the better part of 85 out of 100 years. So only one 15 or 17 year period they've been down in 100 years. So people really don't know what that entails. And you're right. Nobody really talks about that. And by the way, I do mention in the book, well, if we get a recession in the next year or two, you can see a counter trend move in bonds. So I'm not trying to say bonds are going to go. I mean, over time, because of the secular trend, they will go down. But as we know, there can be counter trend moves like bonds. They could have a big rally now this year if we're about to go into a recession. So I do mention that in the book.
Right. Yeah, that absolutely makes sense. Any kind of trend, what's the saying people like to use? Any bull market climbs a wall of worry. So you're always going to see ups and downs. And it's interesting to me. I tend to be, I think, a lot like you. I'm more of a long-term kind of guy. I'm interested in macros. I'm interested in kind of the bigger picture. And I think a lot of people get so hung up in, oh my gosh, gold's down $50 today. Panic, and they're not putting that into any kind of context at all. And I think it's really important to have the context of, like you're saying, the technical analysis where you're looking at the trends and an understanding of the fundamentals that are working in the kind of the undercarriage of the economy, so to speak. So it's good to have that perspective out there. I wanted to talk a little bit specifically about a silver, and you mentioned specifically in one of the things that I read as I was getting ready for the interview, that you think that silver is going to outperform gold as we move forward in this bull market. And I think a lot of people would hear that and say, well, I've been waiting for this forever. We've been kind of range bound, and we're still at 90-1 plus on the gold silver ratio. So why do you think that silver is set up to even perform better?
Well, because we know that from history, when you're in a secular bull market in precious metals, silver will ultimately outperform gold. And I think, I do have my own reasons why I think silver is underperformed, which is also the reason I think the stocks have underperformed the miners in some people's eyes. And that's because gold has not outperformed the stock market yet. It's not broken out fully against my 60-40 indicator, which is a really, really important indicator to tell you, is money flowing into conventional assets or is it flowing into gold and precious metals? And so, as we're speaking, this is this year could be a real turning point where we finally get that shift where, based on the charts here, and again, this is conveying really, really important information, because you have the traditional 60-40 portfolio. And if that's doing well and outperforming gold, then we know that people are putting their money in conventional assets and they're not going to put them into gold. But based on this indicator, you can see that the points when gold broke out or really started moving higher against this 60-40 portfolio, it was a real turning point for gold and precious metals. I think at the end of 2001 and the very end of 1971, that's when that happened. And so now we're coming up on a 10-year base. It is slow. It looks like it's slowly breaking out, but this is really, really significant because, again, we're looking at gold against the conventional portfolio, and this is coming out of a 10-year base. And when a market breaks out of a really, really long base, that has significance for years and years, not just the first couple months or year after the breakout. So this is setting up for a really powerful move higher, and if it happens, which I think it will sometime this year, and you get a real acceleration in gold, people can look at this chart and understand, okay, this is the significance of what's happening. This is a move that's just starting. We're just seeing the beginning of capital flowing out of conventional assets and into gold. And it's also significant because you need those extra capital flows into the precious metal sector and they're important because that's really when silver will get more of a bid and outperform gold. That's when the stocks will do better. So that's really kind of the macro and technical behind silver. I mean, and you notice I don't talk a lot about industrial demand. I will say I don't think industrial demand really has any impact on the price, at least right now. I know that it's really heating up, but for me, it's really gold that drives silver. Silver is a leverage play on gold. But as far as industrial demand, and I don't talk about this in the book because it's not really in my wheelhouse, but it is interesting how, I was talking to David Morgan, who I'm sure you've interviewed, who knows way more about silver than me and probably most anyone. And, just privately, I don't know if he would want me to share this, but he was just showing me some industrial demand data and just projections on what could happen. Like we could, in 10 years, like we could come into a situation where someone tries to corner the market again, just because the industrial demand is growing so fast. If you factor that in with, a secular bull market in precious metals, and metals prices are moving higher at the same time, and you have a lot of investment demand, that could be a real explosive situation for silver. Not necessarily now or in the next year, but something in the next decade we can look ahead to. But and the last thing about silver I would say is you have this technical setup where everybody calls it a cup and handle, but technically it's not a cup and handle pattern. Now, gold's pattern was a real cup and handle, and understanding that was significant because when gold would break above 2,100, it's breaking out of this 12 or 13 year pattern.
Right.
You would know this is really significant. This is going to lead to higher prices. This is going to be a big thing for the next decade. Now for silver, when silver gets back to 50 and breaks above it, to me, that really would be the second biggest breakout of all time. I think I talk about this in the bonus chapter. This is just, you don't see in technical analysis like many 45-year-long bases in the charts. So this is a perfect 45-year-long base. Yeah. And when silver breaks above 50, like it's really going to go crazy. Like if you look at copper, I think broke out of a 30-year base in the mid 2000s. Oil broke out of like a 20 or 25-year base in the mid 2000s. So when a major commodity has that kind of a breakout, they make a really, really significant move higher. So that's just like the history. But then even if you just look at silver just by itself and just the chart in nominal terms, just by itself, you can say when this breaks above 50, like this is going to be a really, really explosive move. Like this is not just going to like $57 or $63. I mean, this is something that could go to 90 or $95, like, in 12, 13, 14, something like that after it makes a breakout. So, I look at that by itself. I look at all these different things, and then you look at the history of secular bull markets in precious metals. And again, there's not a lot of it, but what we see is that the gold silver ratio comes down, and by the end of those markets, it gets under 20. So when you think about that, you think about the technical setup that silver has. You think about industrial demand is really, really starting to accelerate. You look at the outlook for good. So you're factoring all these things, and it just tells you this for silver can be a really, really explosive situation. Not just over the next few years, but over the next 10, 15 years.
Yeah, I agree with you. There's so many dynamics that are in play, and almost zero of them would I consider to be bearish in terms of silver. And as you mentioned, there's that whole dynamic. I think it's important for people to understand, yes, it is an industrial metal. Yes, the industrial demand has a significant role, but it is fundamentally a monetary metal, and it does track with gold over time. And as far as, again, I'm not nearly as well versed in the timelines and the technical stuff as I'm sure you are and people like David Morgan, but I do know that typically it is the latter part or deeper into the gold bull run that you start to see silver making that catch up. It's not usually in the early part of it. We kind of saw that during the pandemic, where silver actually sold off and then rallied later after gold had already started its run. So.
Yeah. Hey, I'll just add 2 cents to that. And that's why one thing I've always said, when gold breaks out, you can buy silver because silver will eventually follow and you don't have to chase gold.
Yeah. Do you follow the Federal Reserve monetary policy closely?
Good question. A little bit. I don't get too much into the details, but I do follow a little bit. It is important.
Yeah, I mean that's kind of one of my pet things, I guess. And I've been kind of watching this. I feel like the Fed's in a tightrope right now because on the one hand, they need to hold interest rates higher because we've still got the kind of sticky price inflation. And then on the other hand, we have so much debt in the economy. There's so many malinvestments from decades of what I would argue is artificially easy money. And how do you walk that tightrope, right? And navigate that when you really need to make two different policy moves at the same time? Do you think that as we move forward, do you think inflation is under control, or do you see more inflationary pressures as we move down the road?
Well, I think if we were to have a recession, inflation will probably come down, but I don't think that would be permanent. Like I think whenever we have the next economic expansion, I think they'll have to cut rates and you'll probably get a little bit of fiscal spending on top of it, even though they say they're not going to do that. At least the federal government right now. I don't think it's under control. I think, again, you go back and you look at the late 60s and the 70s. I mean, there were ebbs and flows. I mean, there were periods where I think the CPI was 2 or 3% on the downside. So I could certainly see it. The CPI or inflation metrics coming down a little bit more, again, if we are about to go into an economic downturn. But that doesn't change the fact that let's look at where commodity prices are. I mean, copper's another one where copper's on the cusp of breaking out of like a 12 or 13-year base itself. So you look at these commodity charts, and you think about gold's breakout and silver coming up. I mean, the markets are telling you what is coming over the next 10 or 15 years based on these charts. Like they're not necessarily predicting it's going to happen next month or next year or in 18 months or 3 years, but they're telling you from a 30,000 foot view, like there is a serious risk of some major inflation in the pipe. And I mean, I short term, or at least for the rest of this year, again, if we have an economic downturn, inflation probably won't be a problem statistically, but the problem is we've already had so much inflation come in that even if inflation gets down to 1.5% or 2%, that doesn't help anybody. I mean, the population needs prices to come down. Like once you've already had COVID and prices are up significantly, that doesn't help anybody. You need prices to go down, and prices going up by 1 or 2%. Yeah, economists love that. There's inflation's low, it's come down. It doesn't reflect reality whatsoever. So I think it's embedded now, and it's going to be a major problem over the next few years, even if we have an economic downturn and prices kind of come down for a little while.
Right. I mean, I agree with you that would be temporary. And then, of course, as you pointed out, the Fed. I mean, if history is any indication, if we do have a major economic downturn, rates are going back to zero. We're going back to quantitative easing, which is by definition inflation, and the price inflation is sure to follow that. So, I see inflation no matter how the Fed goes, But so here's a fun question I like to ask folks that are deeply embedded things. What is something that you see that you think is extremely significant for the gold and silver markets in particular, or you can even think a little bit more broadly in the markets in general, that you're looking at that most people out there in the mainstream on CNBC, Fox Business are completely missing?
Well, I already mentioned it. I would say it's gold coming up now on the potential to break out of this base against the 60-40 portfolio. So again, this is a ratio. So I have 60-40 portfolio data where I made this 60-40 portfolio. It's total return data from the stock market going back 100 years. Same thing for the bond market. So I made this into a 60-40 portfolio index. So this includes dividends too. So, and again, this is an indicator where we're looking at gold against basically the conventional portfolio. And even though gold has gone up since the 2016 low, since the COVID low, since the 2018 low, it has not, I mean, it's gone up a little bit against the 60-40 portfolio in recent years, but it has not broken out of this 10-year base. It's getting really, really close to doing so. And at the same time, we have gold coming up, gold against the stock market. That's in the last day or two, that's been testing a four-year long resistance. So if we are to see these charts break out in favor of gold, these ratios going up, that is going to indicate a real significant sea change where you're going to start to see, doesn't mean everybody's going to sell all their stocks and buy gold and silver, but it does mean that everyone will probably start to move a little bit of their money into hard assets and precious metals, and they'll sell a little bit of their stocks at the same time. And so these charts are so important because they signal where is the capital moving? Where is most capital moving? Is it moving in favor of gold, or is it moving in favor of conventional financial assets? And again, it's great that we're talking right now because we're gold against the stock market, which is 40% of that basket. That's coming up on a 4-year long resistance. So that's really close to a breakout. And the overall gold against the 60-40, again, it's coming up on a 10-year base. And so again, if we get the breakout in favor of gold, that's going to signal the start of more and more capital moving out of conventional assets in favor of gold, and then eventually silver. So that to me is really the key to everything. That will be a big sea change from what we've seen over the last 4, 6, 8 or 9 years or so, where gold has been trending up, silver not as much, the miners not as much. Money's still going into the S&P and the stock market because it's still in a secular bull. But when we get this breakout in favor of gold, that's just so extremely significant, just for gold and precious metals and economy also at the same time, because again, it's going to signal, capital's moving out of conventional assets into gold. That's not a good thing for the economy and financial system.
Absolutely. Yeah, it's funny to me because if you listen to the mainstream guys, every time there's a correction, gold bull market's done, it's over. And I don't know, it's just that they can't seem to see past their noses. And maybe that's somewhat of a function of the world we live in, where it seems like everything is driven by the latest post on X or Facebook or something, and people get all wound up about these short-term moves. So I really appreciate the fact that you're looking at this from a longer lens. And I'm inclined to agree with you. What you're saying from your point of view definitely dovetails with what I've been writing about and talking about as well. So before we go, I do want to give you an opportunity to pitch your book, let folks know where they can find it, where they can find your newsletter, and how they can follow your work so that they can dig deeper into what you're doing.
Oh, thank you. Yeah, the book should be on Amazon in a few days. However, you can get a free PDF copy, and I am going to upload, I think, an EPUB copy so it's easy to read on your device. If you go to thedailygold.com/book, or the same form to opt in is also at thedailygold.com. So I would say you can get it for free there. A hardcover version I think will be on Amazon in a few days. But what I do is I invest and write about various junior companies. I'm not looking at like penny stocks, but I tend to like to look at what are the small gold and silver companies that management has a really good track record, and they have potential to build a mine or build a couple mines, grow production, and really leverage the gains that you get the potential gains in gold and silver and in a real gold and silver bull market. So I tend to focus more on those companies than the really big miners or the really tiny, like penny exploration stocks.
Right.
So that's what I like to do. That's what I write about in my service. A lot of the things that I'm telling you in this interview, service. And I'll just say with the stocks, because I know there's some, people on the metals side, they'll say, oh, we'll only buy metals, don't buy the stocks. Now, I will say with gold and silver and the mining sector and the junior sector, there are a lot of landmines and pitfalls that you can run into investing in the mining sector, which is why you need to have a significant amount of experience and expertise at the same time to know which are the right companies to invest in and which ones to avoid. And so again, I would say if you're someone who, if you're just staring at your computer screen and you're a trader and you're just buying the ETFs, then yes, it makes sense to prefer gold and silver over the individual stocks. But if you're really willing to do your homework and buy individual companies and do a serious amount of research and talk to people and get educated, then my newsletter product might be something that fits your needs. But again, if you're not willing to do the research and homework on individual companies, that's fine. But like over a long period of time, the stocks, a basket of the stocks is not necessarily going to perform better than gold and silver. So again, that's why I say, I know I'm rambling on here, but you have to be really serious if you want to get into the companies. You can't just kind of half-ass it and buy the ETFs and expect they're going to give you this great leverage. If you're interested in the stocks, you have to really be interested in them, the individual companies. If not, that's fine. They just invest in gold and silver. You can trade them. You can trade the ETFs at the same time.
Yeah, absolutely. Well, and that's why we're grateful for folks like you who can help with that type of research and stuff, because let's be honest, most people don't have the time to dig into the dynamics of the various companies and whatnot. But as you say, if you do it and you do it right, you can really leverage the price of gold and kind of increase the value of your investment. So, and you're also very active on X as well. So what's your X handle?
At the Daily Gold.
All right. Well, we'll send folks over there. We'll send folks to your website, and hopefully they'll grab your book, because I think it'll help with all of the charts and stuff that you do to be able to visualize some of the things that we've talked about today. So appreciate your work. Appreciate you taking a bit of time out of your day to hang out here. And we'll have you back again soon to talk again as we kind of move forward into this new wilderness that seems to be developing.
Sounds good. Thank you so much for having me.
All right.
Well, that will do it for this week. Be sure to check back next Friday for our next weekly Market Wrap podcast. And remember to tune in as well to the Money Metals Midweek Memo hosted by Mike Maharrey. That comes out each Wednesday. And to catch any of our audio programs, you can find them on Apple Podcasts, Spotify, other podcast platforms, or simply by going to moneymetals.com/podcasts. Until next time, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a wonderful weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes. For answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds, call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by to answer your call during business hours, Monday through Saturday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.